And we're live.
Well, good morning, everyone, and welcome to Where's the Funding, hosted by the Fiber Broadband Association and sponsored by Broadband.money. I'm Gary Bolton, the President and CEO of the Fiber Broadband Association, and this is our 6th episode of 2023. This is a 12-part series designed to help you understand and navigate and obtain matching funds for broadband grants. You know, the NTIA BEAD program requires a broadband applicant come up to the table with a minimum of 25% matching funds and a letter of credit up front with the application. For many small and non-traditional providers and communities, this may sound daunting, but it doesn't have to be. This 12-part series is designed to help you understand how and why meeting these requirements can be straightforward. You know, last month we had a great session where we discussed navigating the BEAD letter of credit requirement with our guest Phil Mackers of Klein Law Group, Elizabeth Bowles of Aristotle, and Pierce Faircheck of Live Oak Bank. If you missed that, you can go to the FBA website under events or go to broadband.money.io and watch the replay. Today on Where's the Funding, we're going to focus on how to leverage the Capital Projects Fund from Treasury to match resources from private sources for BEAD grant applications. Pete Perlitz will explain how this allows organizations to maximizing their funding potential while ensuring that their projects are able to move forward in an efficient and timely manner. Chris Perlitz is the managing director of the Municipal Capital Markets Group. That's Municipal Capital Markets Group. Chris works with a wide range of investor clients on capital markets, securitizations, private placements, and other financing sources. He funds profiles from highly rated to non-rated. His deep knowledge of evolving financial regulatory landscape has also benefited from the federal lending programs, including the U.S. Department of Agriculture's RUS, Rural Utility Service, and with nonprofits. He holds a bachelor degree from the University of Colorado in Boulder, which is one of my favorite places on the planet. So welcome, Chris. And for our audience, please type in your questions as we go, and we'll work them into the discussion. So, Chris, thank you for joining us from Costa Rica. I am so jealous. In addition to Boulder, Costa Rica is my favorite place on the planet. So I know it's rough for you there. So why don't we, before we kind of get into the BEAD financing, let's start off with, a little bit about you and the Municipal Capital Markets Group. So you're a Colorado outdoor guy. I guess you have a wife and 2 sons. How did you get involved with nonprofits and broadband funding? Kind of what makes you tick?
I came from the tech industry. Worked my first job out of college in Boulder was second job. First job was backcountry ski company. Second job was working for a tech company called SpectraLink, which is if anyone has got some seasonality in the wireless business, SpectraLink had designed one of the first voice over IP wireless solutions out there. We had provided services to everything from Goldman Sachs headquarters, Microsoft headquarters, Bill Gates' house, HP headquarters. Most of the Fortune 100, 500 companies back then had heard of it or used it. But we had designed some junk band technology, so to speak, 802.8 to 28 to provide wireless from microcells. And then I'd worked later in my career on one of the first IPTV networks under EchoStar when they formed a broadband group to do basically, and that's when we were starting to get some exposure to the fiber business. But back then this was 20 years ago, to date myself, but back then, content rights and over-the-top content was just sort of a dream, but I thought it was going to happen in a short-term timeline, but we're still not quite there yet. People are still understanding what the notion of cutting the cord means. But it was around that time I decided to go work. I had an opportunity to go work with a developer up in the mountains up in Vail to develop fiber to the home. Actually, one was up in Truckee Donner, which was one of the first in California to go off and try to build their own utility. It was a utility trying to build their own fiber network, because the services for the projects that we were working on were not getting the sufficient bandwidth and quality of service that they needed in that market. So And then I worked for the federal bankruptcy courts in Colorado. And it was about that point when I realized that I should probably go into finance. So, and ever since 2005, I've been in this space doing finance around this field. I've always had the vision that I think eventually this becomes a utility or regulated utility, either through a co-op or through a municipal utility or through some sort of variation of a regulated ISP. So that's my view, just so you know my perspective. I do believe eventually we'll get there. It'll take probably a number of years, as I thought IPTV would pick up. 20 years later, we're seeing it more affluent, but utility finance or utility broadband is going to become more real probably in another 50 years. So it's going to take a while. But in any case, so our firm has been around since 1989. We were the only firm that I knew back I've been there for about 11, 12 years. That was had interest in the broadband. Back then, it was that Oppenheimer was a big investor. They had worked on Utopia, they had worked on Burlington, some of the early stage developments in this field 20 plus years ago. And so it was nice, MCM. We've got a unique group. We're structured sort of like the way JP Morgan was structured back in the early 1900s. We don't have a lot of overhead like some of the other investment banks like a Piper or Jaffrey or Stifel or whatever, right? We're a little bit cheaper as far as what we can do for our nonprofit clients. But we all focus on different things. I do some policy work with USDA, rural development programs, and I have a lot of success working with that program a few different levels. A couple of the colleagues focus on DD facilities, development of disabled buildings facilities, rural jails, pretty much anything that involves a P3 structure. We've been doing it for a long time. And so we have a lot of creativity involved in our process and a lot of seasonality with our group. We've got a trader who's in his 87, and we've got people that are, that have 50, 60 years of experience in the field. So it's been really nice to be with our group. And you can look at our website at www.capital.com, and you can surf around. There's a little broadband link and things like that there. You can see what we do.
It's funny. You're talking about how fast the pace of change. I remember back in the early 2000s, I was on a panel at the FCC with Dave Kettler, was the CTO of Bell South at the time, and he made this comment about the thundering hooves. You can hear the thundering hooves of the Arbok tortoises.
Yeah.
So things take a little while, but yeah. So you talked about USDA. Monday, the USDA awarded $714 million from the RUS Reconnect program to build out these 33 build outs, 19 states, 90,000 locations. That's about 2/3 of the $1.15 billion from Reconnect 4. That seems to be a lot. There's Reconnect, RDOF. We got all these programs out here. We just saw that Gumbo 2 is just got approved by the legislature in Louisiana. So, how should a community look at all the funding out there and figure out where to start?
Well, I think the first thing is to look at yourself as far as an organization. What is the socio-demographic market you are within, right? So all of the federal subsidies, let me just take a step back. I'm a big fan of grants when we can get them, but you can't rely on the grants for a project. You should always sort of have a strategy how to do this with minimizing the grant process, because grants, as nice as they are, there's a lot of hooks and checks and balances and process with the grants, and sometimes in some of the current grants, they don't even know what they're going to do on the back end to manage it, right? The federal government. So if you can sidestep the grant process, great. But in those markets that are rural, you're going to have qualification requirements based on your population, based on your median household income. All of those will have an impact on what type of grants and how you go about getting those monies. And then the struggle after that is figuring out how you build out the project, because the grants aren't going to cover the whole thing. They'll just cover a portion of it. So I think the first thing is to figure out if you're an urban market and it's a tier 1 city, there's different types of paths you would go than if you were, let's say, rural. So if you know you're rural, then you know the USDA is probably a pretty good trajectory. Doesn't mean you can't pull in other grants, but yeah, the RUS has been a really good vehicle for this. It goes back to the mid 1900s, Rural Electrification Act and Telecom Act. The USDA had started that helped build that program, and it's been the reason why we have telecom, right? At least in some of our rural markets, and so it's picking up the slack here for co-ops and for for broadband and wireless. So.
Well, let's jump into muni bonds. So, can you give us a little education on municipal bonds and how can how can a municipal bond help finance the match?
The match. So we focus on so the first thing is, just so you know, municipal bonds are qualified as tax exempt bonds, which means the investors don't pay taxes on the investment, which means that generally our yields are going to be lower than what you get in the general banking world, right? Banks don't have as much interest in tax exempt investments. 85% of the investors in tax exempts are high net worth individuals. They really benefit. They're at that 40% tax bracket, so they get a real benefit for those investments. Up until about 2010, tax exempt bonds were a lot lower than even the treasuries for highly rated investments, just like a U.S. Treasury is. Up until about 8 or 9 months ago, it flipped back to normal. So for the last 10 years, everyone out there has been drunk with, banking rates and low treasury rates and everything like that. So the world is getting back to normal. And typically tax-exempt investments are a good vehicle because you can do smaller pieces of it. You don't have to go out and issue corporate bonds at 100 million at a click. You can go do smaller increments of 5 million, 10 million, 15 million a piece, and you can throttle your size based on what your demand is. A lot of them are what we're seeing in this space are revenue bonds. So we're leaning on just the revenues, the quality of the network, how it's getting built, the timing of it. There's a lot of mistakes over the last 25 years in this space of how people have gone through the process. Utopia went through, I think, 3 different versions of resetting their capital process. So, that gives you an indication. Even the best in this field have had problems going through the process of raising capital. Your revenue bonds are what we've been doing, and just really understanding the field that I have on the tech side has been helpful for us in working through the underwriting process and making sure that particular borrowers knew what their operation risks are, what their take rate risks are, what the competitive risks are, what the technological obsolescence risks are in the process. And it's a full suite of analysis going through the process of raising money on revenue bonds. And there has been mistakes over the past. A lot of bankers out there will always say, well, let's issue as much as we can. Right? There's some good examples out there where, let's say, Kentucky Wired or some other states that have issued a lot of debt. Why would you issue that much debt at once? Why don't you do it in stages, right? So tax-exempt bonds will allow you to do that. So you don't have to do one big swath of raising the capital. You do it in pieces. You do it organically over time. Decrease your interest liability. Make you get on track so you know what you're doing before you start issuing more debt and carry more weight. So it's just a proper process that should happen, and it's in this field, like other fields, it's a struggle to get people to understand. Right?
So, when I did startups, we would do our series, our seed series and Series A and B and so forth. So we'd raise in stages, but the investors would have so much capital under management that we knew that we'd be able to go back and get more. Is that the way you look at it, is to say, okay, here's some milestones and we're going to, do our first, bond, and then we'll get these milestones and we'll do our next raise and then do it in those kind of stages? Is that the best?
Correct. Yeah. And the investors in this are big, large funds. I mean, there are individuals, but most of those individuals invest in those funds, like a BlackRock, a Goldman, Allspring are the big notable players in that basically hold tax-exempt bonds for their investors. And a lot of times it will go back to those same investors, right? You'll just keep going to the same guys over and over and over again. Once they understand the credit and they underwrite it and they feel comfortable with the analysis that's been done, then it's like flipping a switch, right? Next year you do another one, next year you do another one. So we've been doing that with East Central Vermont Fiber over the years. We're going to do another issue this year, later this year. And every time we do an issue, we do it incrementally when they need when they're building out the project, right? And that's been very efficient for them. And the investors are very comfortable knowing that they're not overextending themselves on how much they're issuing every year.
So can you give us, you mentioned one of the deals, but can you give us some highlights of municipal bond deals that your team has structured?
Well, East Central Vermont, we've done everything. Well, our team in the broadband space, we did East Central Vermont. We've done sort of some advisory work with states. We did a project out in Oregon. One of our colleagues did. And yeah, those businesses are far and in between, right? Because a lot of times you've got a lot of consultants are coming and advising on structure. If it gets to be an investment grade, we're generally not going to be in the mix. We can do investment grade, and I do investment grade investments, but a lot of times we're focusing on the non-rated tough credits and kind of helping them navigate that. But the process for which generally when we go into those projects, they're just in the beginnings of their capital process, right? They've maybe got some basic infrastructure in place. Most cities today have some rings or some fiber, assets that are already existing. Leveraging that can be a big help. But yeah, working through the process and making sure all of the checks and balances on the financial model are there is what we're focusing on these smaller issues. But it's it's hit or miss. Just some people can get through there. Some people get through the notion of what they have to do, and some can't. I mean, there's a political process, so you have to be thoughtful to that, right? How they're going through their procurement process can be different city by city, et cetera. So we, as a company, we've done, in the last year, even we were at least right now, I'd heard we're number 2 in the financial advisory for negotiated underwritings in the capital markets. We've done, I think, in the last 4 or 5 years or six years, probably 15 to 20 billion in advisory work for utilities. So there's a whole litany of clients. A lot of those are state collaborations of utilities that are banding together to go buy prepay of natural gas and things like that. So client-wise, when we go back to '89, we've kind of led the market in several different utility sides of the business. So I can give you references galore if you want them. But yeah, so there's a lot of creativity out there in our space, which is exciting.
So what's the max leverage or percent match that you have on a deal?
You generally see and it's what drives it is the financial model, right? If you've got what we see about 50% asset to loan value, or equity, if you will, to loan value is usually a good baseline for where the economics make sense. And it doesn't have to be a big project; it could be relatively small. But generally, in my experience, I think once you have about 50% of the first, now I'm talking the first phase. So if you were to do a small $10 million project, it's good to have, generally speaking, if you've got about $5 million there, in some form of collateral or asset, cash that helps you get there faster, and makes the economics a little more viable. Remember, our whole goal here is to find a really low ARPU for the client, right? In the muni space, it's a race to the bottom. In other words, the bottom line is zero, right? In the ISP space, the race is to make as much profit as you can. So there's different sort of viewpoints, ideologies on which direction you want to go as far as who's going to own the asset and who's going to lever it. So yeah, and those can be different. I mean, you can lever quite a bit with an ISP. You can't lever as much with a muni, right? Because they're generally more stable entities, but they get the benefit of that in the market. But they also want to have some level of security that you can execute, where we know an ISP can probably execute, right? A muni doing it or a utility doing it for the first time, not sure they can execute quite yet. So there's less leverage.
So when you said assets, I mean, obviously cash is king, but leveraging an asset, what do you guys what works for you guys as far as assets?
It all depends on what capital you need to put in the project. So if you've got a ring, for example, and you wanted to extend out that ring to provide services from the existing ring, then you already have an asset that you can use in the network. So you're not having to build. If you don't have a ring, then you have to figure your cost of building the ring is going to be more expensive. So if you have a ring, all you got to do is set up the operating costs of building that, of extending out from that existing ring that you own. And that can be relatively cheap, right? Then it's just an operating expense analysis. And you've got a ring, so you can extend laterally from that ring, and that'll generate revenues to pay for the debt service. So we'll look at those, those numbers to make sure that you have enough projected revenues to pay for the future debt service of the existing asset.
Yeah, no, that makes a lot of sense. What about, let's talk about timeline. So how long does it take from the initial plan to market with a non-rated municipal bond deal?
We can turn one in 30 days. I've done them in 30 days. It just depends. It all boils down to the borrower, right? Who's trying to raise the money and can they get their ducks in a row? But typically speaking, I'd say probably 30 to 60 days from soup to nuts. The process is you have to determine, and really in this business, one thing that I think that people forget is there's a lot of structure options out there to be creative in how you're issuing the debt. It doesn't have to be the municipality who issues the debt. It could be a third party sponsored entity like 6320 Corporation or a joint authority, intergovernmental agreement across all the counties. Those entities can be the borrowers. They don't have to have a huge balance sheet or any balance sheet at all. They just have to have an arm's length connection to the city. The 6320 is the nice thing is, and we're working on one of those at the moment. Those assets roll back to the city at the end of the debt. So after this thing's paid off, the cities can take back the asset. So you form a separate entity that will do that work. And 6320s will work for co-ops and other things. But there's a lot of structural sort of fundamental questions that go into that, to the answer to your question, right? Does that make sense? So it's not just an easy muni city issuing debt. If a tier one city is issuing debt, their credit's great and they can get cheap capital and there you go. But the problem there is the political undertones you have to deal with competing against your incumbents in those markets. And generally, that's a hard thing to do from a general obligation perspective, issuing taxes or something like that.
So can an ISP access the municipal bond market without the credit of a municipality?
They could, yeah. So there's industrial development bonds, private activity bonds. There's certain vehicles that we can use in the tax exempt space that can allow you to access that cheap capital. There's various restrictions depending on state to state and restrictions depending on the use of those funds. Private activity, you can do, I think 10 million is the cap. And you can go up, and so you can have each, let's say, is a seed money, right? And then each county you can have, I think, only four different private activity bonds per project, but you can have various districts that would issue it individually. Does that make sense? So you can carve them up in different sections, and then have up to four different private activity bonds working in conjunction for the same kind of network. And that's a legal question, frankly. I'd rather, Red Book Bond Council would be able to provide some more flavor to that. Happy to talk with the state Red Book authority on those notions of what they can do and can't do.
Well, since you brought up PABs, there's so many innovative ways that the public and private markets can participate utilizing, a lot of these poorly understood tools to get fiber projects done in BEAD. Would be great to explore some various tools that can you do a brief primer on the resurrection of private activity bonds and what that'll mean, a unique P3 funding models, different solutions that you guys can.
Well, the federal government actually relaxed the rules on private activity bonds to incorporate broadband. And that was something that occurred a couple of years ago that has allowed us to venture into that field more aggressively with the broadband side, which is great because I think it brings more of a P3 relationship to the need here. Um, PABs, again, are limited, but they could be a good source for seeding a project, right? Once you get that 10 million, you can go. Again, when we underwrite these, we have to look at what is the feasibility of it? What does a pro forma look like? We'd have to understand who the operator is. If it's an ISP, we want to really understand that ISP. And like you said in the very beginning, you get different series, right? So you could have a Series A as a private activity bond, and over here you can have a B, which might be a taxable tail or something like that, or you could do different creative structures. There's even some sub debt and some equity, subordinated debt equity options that we've used in the past, which could help bridge the gap for that capital need. But because the capital is so cheap on the tax exempt side, it's easier to go. It's worth going down that path. Plus, you also going through that process, you also get some municipal exposure, and then you really get your political, support or not get your support. So it will help guide you where you sit within the community. And it's always good when we're doing these to understand what kind of political will there is. Is a muni behind you? They're going to support you to help you get there. So that's a key point of going through the process. It seems like a pain in the butt, but it's really worth it in the long run because those might be your clients, right? If you're building a network and you're separate, and you're the city, it's one thing. But if you're a separate entity, you want to have that muni be involved in your process because they're ultimately could become your anchors. Right?
Yeah, I didn't even think about that. So you really, when you're building your capital stack and you're, raising bonds and so forth, your series, I guess, you don't have to use the same instrument each series. You can look at the maturity and where you are in the project and what the market environment is at time of the raise. And it seems like a lot of different factors to see what the strategy is and what, the debt instrument or what type of debt instrument. And
yeah, and it's also nice to know when you do capital markets work, you can bring in banks. A lot of times we'll bring a local bank in to buy we're working on one up in Wyoming, and we're going to hopefully bring a local bank to buy a small tranche, let's say 100,000, if they're interested. Like I said, not a lot of banks are lending right now, but we can carve a little bit of piece here and there to satisfy the local investment. I think it's important to have them involved. So that brings more political will, and that drives more momentum within the project, et cetera. So that's a big part of the process we like to bring into the mix here.
So earlier you mentioned municipal advisor. What's the difference between a municipal advisor and an underwriter?
So Dodd-Frank had created a rule that you can't provide advisory work, and you can't be advising a city and not notify them of your fiduciary responsibility, and then also underwrite it. So in other words, there was a few projects that went default back in 2009 and 10, where there was someone advising a city to go do something. Let's say build a sewer system, right? And they were advising the city to do it, and then they turned around and they underwrote it. So hey, this is the structure you should use. Oh, by the way, I'm buying it. Right? There's a conflict of interest there, and so part of the rule was of separating the two is that you have to define yourself as an underwriter. You have to define yourself as a financial advisor and municipal advisor. I think that's a fair differentiation. Now, if you're engaged as an underwriter, you can't provide advice within limits, but as a municipal advisor, your fiduciary responsibilities to the borrower. If you're an underwriter, your fiduciary responsibility is to your investor. So you have to define that role up front. We do both. We can work as a municipal advisor or an underwriter. We just have to define that role up front. And there's various documentation involved. And frankly, that's one of the things I think that lacks in this field. There needs to be more sort of advisory work to help that understands broadband, right? Advising people to go do a general obligation bond is really not going to satisfy the problem. It's someone who knows broadband that can go in and dig through the financial model and do this optically best for the client instead of just, hey, go out and do a tax issue, and because anyone can do that, anyone can underwrite that, right? You're using the taxes. So you really understand the field is important to be able to do it properly.
Hey, so I had Joey Winder on Fiber for Breakfast several weeks ago now, and he had said that they had already issued about half of their $10 billion of capital projects fund. So where are we in the window? Is it too late to try to go after capital projects fund, or, where are we? And should people look at ARPA, or how, what money is available that they should be looking at?
And again,
For a BEAD match. Yeah.
I'm sorry?
For a BEAD match.
Or for a BEAD match. So one thing we've been doing for BEAD, at least contemplating with these folks, is that we could bridge the BEAD funding with a grant anticipation note. So, and even like I said before, one of our main goals is to bring the local lenders, the banks involved, because right now they are not lending, right? And so to ask a bank, I'm sure Live Oak is great. They're doing a lot of work. There's a lot of banks out there that can lend, but there's a lot of them that can't. The lion's share are not doing this type of thing because it's too risky for them, right? They don't understand broadband. They don't understand the economics. They're not going to extend themselves from a credit perspective, especially the regulators aren't going to like it. CRAs aren't going to drive the underwriting, right? CRAs are nice to have from a regulated perspective, but they're not driving the bank's ability to underwrite. It's important because a lot of people misconceive that. But nonetheless, what we've been doing is bringing a local bank involved. Let's say, for example, you have a BEAD borrower. We could do a grant anticipation note and put the funds sitting in a trust account. And then the bank can look back and say, okay, well, we're going to use that funds in the trustee account as collateral to provide the letter of credit to support the project. Does that make sense? So we would fund it into a trustee. We won't release the funds of the trustee under certain conditions until the project's ready to go, until, et cetera, et cetera. One thing to note that's happening more recently that wasn't available 6 or 8 months ago is we're seeing big arbitrage spreads. Arbitrage is a difference between how much rate you're paying on your loan versus how much, because we advance fund because we're setting the rate when we close. How much money you're paying interest on your loan versus how much reinvestment you're getting off of the loan. So when you put the money in a trustee, you're going to earn, let's say, 1 month treasury at 5%, and your loan is, let's say, for a 1-year ban is at 5%. Well, your rate is practically zero minus cost of issuance, right? So the arbitrage could have a big impact on these economics, and that didn't exist until, like I said, 6 or 8 months ago. It was happening before 2009. We were looking at arbitrage rebates and things like that, but now we're back to that, and that's great because that means our loans are going to be more effective than they were, for the last 10 years. Again, the last 10 years is a different oddity in the market as everyone else, and so we're going to get back to normal.
Yeah, I don't think we'll get to see those days anymore. But
no, people don't want to
interest rates were nice. All right, well, listen. Enjoy your time, Chris, in Costa Rica. Such an amazing place. I really appreciate you taking time out of your family vacation to talk to our audience today, and you have a wealth of knowledge. So maybe I'll catch up with you in Tahoe in a few end of the month or end of July.
Yeah.
Chase's thing. But you guys enjoy, and for our guests, please dial back in next month and for our next episode of Where's the Funding. So thanks everyone for joining us, and we'll see you next time.
Thanks, Gary.